Hi, thank you everyone for attending. So this will be an investor panel discussion. So let us welcome our panel investors, which is Mita, Dianu, Navas, Ibin, Navas, Amit, and Rishabh. Guys, want to have a seat first?
Okay. Hi everyone, and thank you for joining us. And a very well welcome to this panel discussion on aligning profit and purpose, the unleashing of the potential of impact investment. So I am Mita Misra, the APAC head of Green Art Capital, an impact investment and analytics fintech based in Singapore. And it's my pleasure to host this panel, which is on a very hot topic at the moment. And I'm delighted to be joined by a very distinguished panel of speakers who will share their thoughts and experience on this particular topic. Our speakers today all hail from firms whose mission it is to support transformative, innovative, and scalable solutions that will create a lasting impact on the world. So we have Amit Singhal, founding member of Fluid Ventures, a VC firm headquartered in India. Jhanu Das from Agility Ventures. Rishabh Malik, managing partner at Jungle Ventures, one of Singapore's largest VC firms. And Navas Abin Mohammed, managing director APAC at Mars Growth Capital. So before I come to my esteemed panelists, I would just like to set the scene of impact investments and help define what we're actually going to talk about. So over in recent years, we have heard many terms associated with social responsibility being used in the context of business, organizations, and investments. So impact investments, as specifically defined by the Global Impact Investment Network, GIN, are those investments that have the intention to generate positive, measurable, social or environmental return alongside a financial return. All businesses and investments have impact, both negative and positive. And with exposure to supply chains, employee practices, products and services, leadership, and their environmental footprint, businesses specifically play a pivotal role in society in terms of their tremendous impact, whether intended or actually unintended. So balancing innovation, profitability, growth, and impact is a delicate and probably quite a difficult task, and our panelists can share their best practice and experience on how they actually achieve this. So Rishabh, I'm actually going to come to you first. If you could please introduce yourself, and maybe we can start with defining how the sustainable investment sector has changed over the many years. And also, I think what would be quite interesting for the panel is to see what specifically you have seen change in the wider market, and then how Jungle Ventures, your firm, has adapted to these changes.
Sure, thanks. Thanks for having me. Rishabh, I'm a partner at Jungle Ventures. We're a Southeast Asia and India-focused venture capital fund. We've been around for about 10 years, a portfolio of 70 companies. Key markets are Indonesia, Vietnam, Singapore, and India. We invest from pre-seed to Series B. To answer the question, I think it's an interesting one. I think the intersection of profit and purpose, right? How has that changed and transpired over the years? I think it used to be more siloed earlier, in the sense that you had impact-only funds. I think impact-only funds typically had lesser orientation towards profit and more towards purpose. The returns expectations were adjusted based on that, but capital pools were smaller. I think if you look at the last, I would say, 7 to 10 years in the region, I think that pool of capital has become larger, and even the pure profit pools have become more and more focused on the impact side of things. Today, as an institutional investor, a lot of our LPs, which could be development finance companies, the IFCs, the ADBs of the world, or even large family offices and institutions, require us to have fairly stringent ESG guidelines and require us to measure several different impact metrics across the portfolio, across the region. So I think the overall awareness has improved a lot. As a result, the profit pools have become higher. The capital pools have become higher, and I think the general expectation around lower profit because of purpose has slowly faded away. In the sense that I think that there is a parity now between both of those, and there are investment opportunities that can generate very very high returns for you, but still be very very impactful. So that's sort of my initial take on it. I think when you look at the region, you see different types of business models and different stages of evolution. When you look at an Indonesia versus a Vietnam versus an India, for example, if you look at electrification of vehicles, I think India, if you look at any market outside China in Asia, India is probably way ahead. We do about 1 million units a year in sales. There's significant government support and subsidy to different stakeholders in the ecosystem, and so you see some business models further ahead in different countries. And similarly, if you look at let's say carbon trading or other sustainable business models, you'll find other Southeast Asian markets ahead of others.
Great, thank you. And that's actually a point that you've made that I'd like to bring into the conversation later with the wider panel with regards to the regulations that are actually potentially driving a lot more of this adoption of the impact markets. But following on kind of this theme of the market and its potential growth or its actual exponential growth over the last few years, Navas, I want to come to you and ask you, why do you think impact investing is actually more important today than ever for specifically institutional investors and maybe also the private wealth who have started dabbling their toes a little bit more into this?
Yeah, thank you very much, Mita. I'd like to take it from where Rishabh stopped, right? He was mentioning that obviously there's a misconception that impact means lower returns, which obviously many people have started realizing, including institutions have started realizing is a myth. You can actually achieve almost market returns while still doing impact investments. And I think the way people define impact or impact investment is quite narrow these days. You tend to focus on environment. You tend to not focus on what's the indirect impact that can have on the social or the economic development, right? So many of the businesses, I'm sure all of us sitting here, we are all technology investors. So to a large extent, technology has actually created some sort of meaningful social or economic development or change or impact when it comes to marginalized communities. You think about fintechs that lend to people who are unbankable. You talk about many other businesses that have been actually utilizing these kind of opportunities for people or parts of society that has not been actually addressed to, or they've not been given the kind of attention that they actually deserve. In that way, there's been a lot of change with technology, what technology has brought in. But there are other sides to this picture as well, where we should understand that web-based technologies also contribute to an extent to more global warming and other things. So this is, as an institution, we are invested in by, we are MUFG funded fund, right? So MUFGs are only LP. Every single investments that we do, we follow the policy that MUFG has created, which is organization-wide. And MUFG as an organization has a very, very serious outlook on impact and ESG. And when you look at it, what I think is the problem today as an institutional investor, and it's an opportunity. It's not that there is not enough pools of capital. There is actually a lot of pools of capital. And I've seen this report very recently, which was released. I see that a lot of the investment in impact tend to be focused or concentrated in what is perceived as low-risk markets. So you see 25 to 30% of the investment going into US or North America. And then you see a lot of the investments being focused or concentrated in Western Europe, and not a lot in South Asia or Southeast Asia and East Asia, maybe even Middle East. You have funds that are expecting less than market expected returns in sub-Saharan Africa. But what we see is that, this is the gap. So for institutional investors, I think this is a moment of reality because as investors into these markets, what we're realizing is these markets are actually returning better. And in fact, better quality companies are coming out of these markets. So if you are an institution who's actually looking at lower risk, but still getting the kind of returns that you want, these regions, which has traditionally not been serviced as much or has not got access to that much capital, has a lot of potential. And also, I think when you talk about the entire global scene, I believe that the impact investment is a point, because ESG, to an extent, today, right now, ESG is at a stage where probably technology or web-based technologies were like 20, 30 years back. There was this dot-com revolution, and then that created a set of companies that was like really changed the way we do business, or we live our life, right? So the same thing, I believe, is going to happen in the next 5 to 10 years. You'll see a lot of interesting companies that will come out that will meaningfully change how we live and how we do business.
Thank you, Navas. I actually am going to just stay with you for now, because I think you made a couple of very interesting points that maybe we can elaborate on, and I'll bring the other panelists in. And one was a regional focus for a lot of impact investors, that a lot of the money was going out into Europe and the US potentially. And that was potentially a constraint with regards to this region. So would you, open this to the panel with regards to, is there a lack of opportunities, like investment opportunities in this region? Because like you mentioned, like you've both mentioned, the pool of capital has not been in short supply. There has been a lot of demand for impact investment. There's been a lot of demand for sustainable finance, but potentially a shortage of investable opportunities that are, risk ready.
I would tend to disagree. I think the scene is definitely changing. One of the things that definitely has to improve in the region, and I'm not saying anything specific to the any specific country, but the governance systems has to improve, definitely. So when you talk about companies that are coming up, startups, or even late stage companies, I feel the governance mechanisms are not as strong as a comparative business globally, right? So when you look at a company, an investable company, or a potential portfolio company, you're looking at multiple things. You're looking at how well that company is managed. That goes into the risk underwriting that you have. So if you perceive the company as being generally well managed, and the governance mechanism is in place, then you feel very comfortable investing into it. And at least what I can say is, from our experience of having invested, and we've only invested in the last 3 years in the region, I believe we've seen a lot of success stories. We've not had a single default, and we provide flexible capital, and we've not had a single default. And I think it's a region that people should really look at with more interest, and I think the risk has definitely reduced from what it would have been probably 5 to 10 years back. That's my take on this.
Okay, no, that's interesting. Dianu, I'd like to come to you next, please. And very welcome to add on to, in your experience, to the previous question. But also, there are two megatrends that are obviously driving kind of the most sustainable impact investing market. One is something Rishab mentioned earlier, and that's regulation. So we're seeing a lot more regulations come to the market with regards to accountability and transparency, and bringing credibility to the claims of impact, specifically in an area of increasing claims of greenwashing. And we've seen a lot of banks or financial institutions being fined, like in this regard. And then the other is, of course, investor demand, and the demographics and kind of the wealth transfer to the next generation, who are probably a little bit more socially conscious with regards to their investments and where they want their money or capital to be deployed. Are these factors that actually influence your origination, your deal sourcing, or the way your firm operates in its process? Have you had to change your approach? Maybe talk us through how you look at these factors, or if they actually play a part.
Yeah, so to answer that question straight, I think more to do with this, definitely, we all are getting conscious and cautious of what's going on around the world. And it does impact investment, especially when it comes to, government and regulations. It have to impact any investor, and it will impact. It does in India as well. We definitely are, as investors, becoming more cautious of looking at the factors where, where the policy or the regulatories are moving toward, and we are also following the ESG guidelines for the companies we invest in. Uh, we definitely avoid the companies who are avoiding the guidelines. We do not look at those companies. But overall, I think it is becoming much more uh, responsibilities of the investors to invest in the companies who are making the impact, who are making the change, who are making the difference. Because everything flows from the investor's point of view. If investors, when they invest in the companies and the companies are not being told to follow the guidelines or are just told to focus on the growth, just on the growth, then definitely, a lot of startups, a lot of large companies also make mistakes, and mistakes are so large that, as you just said, that the bankings and all are been fined on these points, and those are the pressures which they feel the heat, whether it's from the IPO point of view for investing or from the large investors point of view for investing. And when it comes to generational wealth transfer, I think that's where, when it comes to, they have the guidelines set, they became large by, going through all the uh, development of the different generations or the countries. They understand the rules and regulations followed by the different governments or bodies, and that's definitely helping the generational wealth transfer make decisions much faster and toward the sustainability or the growth, which is for the I would say, impact on the world, or at least to around them. And definitely agree with Nawaz that, when it comes to the opportunities, it's all around the world. We must look at uh, the the world which is yet growing, because if we keep putting the money into those world with no point of ESG or no point of sustainability, then they will become a mess in the next 20 years. If we look at the same, with the same eye in those countries where the growth potential is huge, and we put these guidelines by advocating the policies or taking the partnerships forward in that sense, it will make a huge impact, rather a much better impact, because the countries which are already economically stronger or which are already the first world countries have already been changing their stance toward absolute investing in the impact or sustainability. But the countries which are still being counted as the third world countries are yet to find their way to become a better economy or something. So if we as the investors and the the growth catalyst can help them even advocate the policies, this will help a lot, definitely.
Thank you. Amit, let's come to you. So all your firms are VC firms. You generally invest in kind of high growth, maybe high tech areas, providing them either debt or equity financing. But what can VC funds do to help startups aside from just providing that financing? Like, how can you support their growth and innovation?
Yeah, correct. We, being a fluid venture, we are a micro VC fund where we strongly believe that every money is not the same money. As a fund, our main core role is to grow them, to help them wherever they are required. So we always, apart from putting money, we help them in various way in their growth path. And as we mentioned, the ECG is also a very important criteria for us. We always evaluate our company that how much impact they are creating. Take an example, we have a portfolio company called Shumi Toys, who are into wooden toys, and they are creating a great impact on the child. SK Paris, they are into vegan leather. They are doing experiment, and now they have find out a way to create a lady's purse through vegan leather. So fabric lore, I can give a number of examples of our portfolio company where they are creating a great impact, and this is an important criteria for us as well before evaluating that how much impact they are creating. If I will go to my angel investments, my Mandi is the one where they are creating thousands of life who are cart pushers. So coming back to your question, so apart from money, every investor has a role in their journey, and that's what we also are playing.
Great. So to yourself and the rest of the panelists, do your firms provide any kind of flexible financing to actually help startups with regards to their specific cash flow needs or financing needs?
So we at a fluid venture we have only option to invest in equity. So flexi funding we do because we invest in a company on a stage manner where we first of all invest 250k to 300k as a first check, then we keep aside 300k for the next round of funding. But our fund thesis is very simple, that we only can invest in the equity financing. We can't provide debt financing to the company because that is the fundamental thesis of our company.
Maybe to answer this specifically, we provide debt or flexible financing. The idea is that if you are, let's say, a B2B marketplace or some business that is based out of countries where you're supporting these SME institutions that or sellers who have no way to actually sell to what you could call as a global north, right? Because they are relatively difficult or not accessible to them. These sort of businesses require a lot of working capital, flexible financing, and that's where we provide and support them, right? And we've seen that has had a tremendous impact in the amount of number of businesses they've been able to support under them, right? People's lives that have changed as well. There's no real metric that calculates this, but that's evident in the way the customers that they serve. And I think that's what we do.
Yeah, so I think for us, it's similar to what Amit was saying. We're equity-only investors. We can be flexible on investment structures and terms, but we focus only on equity investing. And I think the difference between the two of us here is that they're single LP, large conglomerate backed, and we have different family offices, sovereigns, and other institutions that have backed us. And so the mandate is equity only across stages, across geographies. We get to be flexible sometimes on terms. We have partners that can come in and help with different things. Could be all the way from technology grants, it could be to debt access and so on and so forth, depending on the market or the stage of the business, but primarily equity.
Sorry, just wanted to stay on this, and you can answer the same question actually, Dhyanu, is when you provide your equity financing, and if you have a relatively impact-focused investee firm, or you've done an impact assessment and decided that this meets your certain target objectives, do you write into the term sheet, or is there a way for you to incentivize your investee or portfolio company to meet certain impact targets or KPIs as part of the term sheet?
We can. I think we have the flexibility to have structures like clawbacks of equity for the management team or the founders, or be able to take a certain part of the ESOP pool, etc., and incentivize the right people for the right milestones. We have done a few climate investments in the last couple of years, and we've used management incentives based on KPIs. It's been more something that we've agreed on at a board level. It hasn't come into definitive documents, but it's probably just a matter of time. If we do more of it, that it will.
Because it'd be interesting to see how that actually, translates into work on the ground, right? If it actually has an impact. Sorry, Dhyanu.
I think yes, definitely. We have not so far, but yeah, we have provisions where we do incentify and all that. And when it comes to, funding, we are also equity-based fund only.
Okay, so maybe let's move on to investment opportunities, like within the impact space and within the specific sectors or regions that your respective firms look at. So can you maybe let the audience know, like, what do you see? And I think a lot of you cover Asia, maybe Southeast Asia and the India, sub-Asia, South Asia markets. What do you see as the investment opportunities in Southeast Asia versus maybe a just more larger, more mature market like India, which has obviously quite a lot of impact investment already gone into that market, where Southeast Asia has actually had a lot less capital inflow from an institutional standpoint. Have you seen the differences, and are you now kind of exploring different markets with regards to opportunities?
So I think when we look at India, it's the fastest growing, the largest economy, becoming the third largest economy in the few years, targeting at that. India is definitely, growing at such a fast pace that we investors who are looking at India or Southeast Asia are not getting, time to look at the opportunities outside it. And when it comes to, Southeast Asia, it is very diverse. A lot of, different countries, different governments, different regulations. So opportunities are equal in both the countries, and challenges are also same in both the countries. I think uh, my personal viewpoint is India is definitely going to be contributing at least 25 to 30% of the global growth this year, and will definitely keep on continue doing that. And so is definitely I see Southeast Asia, which is, if we put together both these places, they may contribute about 40-45% of the world growth this year. Otherwise, the Western world is definitely suffering to a point that you can see the economic downtrends and the kind of market crash is happening there. So that's my viewpoint. I think we are in a great space.
I think I would say that it depends on the sectors. If you look at particular industries where there have been tailwinds for different factors, you see those industries mature faster. I was talking about electric vehicles earlier. I think India has copied, or not copied, or taken a few leaves from the China playbook in terms of the subsidies and driven mass scale adoption. Also, air quality and pollution is a significant problem across the country, and so they needed to. Similarly, if you look at waste management, elimination of single-use plastic, sustainable packaging, you see India ahead of the curve just because of the sheer scale of the problem, and so you see faster innovation and then a lower cost structure to support that. So I think there is no one answer to the whole region. I think it the nuances vary when you go to different markets. I think when you look at Singapore, much smaller, but when you look at, let's say, carbon trading, carbon management, offsets, you see the regulator being a little bit more forward thinking than some of the other markets. So you're seeing innovations coming there on the software side. As Jungle, we've invested in a climate software company that helps real estate managers future proof their investments based on climate risk. Uh, the awareness around real estate fund managers in this part of the world around those factors is lower. And so what we find is this company is able to go to market much faster and more effectively in North America. Also, the quality of data available around climate risk and how that affects valuation models is significantly higher. So, I think the answers change based on the subsector, based on the geography, and some of the local market nuances. But yeah, those are some initial thoughts.
Yeah, my viewpoint is definitely as the same as what Rishabh said. It's very difficult to say that certain sectors, but opportunities across sectors. I think fintech has definitely, when you're talking about onward lending to SMEs, unbankable. Southeast Asia has also got very good, use cases, examples of success stories. But we are also very active in B2B marketplaces, those sort of businesses where you let sustainable initiatives and social that create social impact on the ground. I believe that's an area where Southeast Asia definitely can improve a lot. And we don't see many quality companies in that space. Of course, the education across the spectrum, very important. India, I think there are some really big success stories in India or South Asia, but not exactly too many in Southeast Asia. I think that's another opportunity. But we should not limit ourselves to. I think every single sector can have some sort of social or economic or environmental impact, and that's the way we should look at it. And depending on the particular geography that we're talking about, we have to just identify what's the opportunity there and try and understand what's the measurable impact that you can create. And that's how and this basically will happen, I believe, for sure. But we are not yet there. Just that I think there needs to be a little bit more education also across the institutions need to realize that there are these opportunities. They probably will have some pilot programs like those of ours, and and then this will change. But very difficult to say that certain sectors is prone to more change than the others.
I echo what Rishabh and Nawaz mentioned, that there are different sectors which are doing well in different countries. We as Fluid Venture, we are betting on the India consumption stories, and we always measure the impact, that how much impact can be created by this kind of direct to consumer brands. So that is an important criteria for us. But as of now, we are largely betting on the India consumption story.
Okay. I think before I carry on with my questions, I'd actually like to open it up to the audience to see if they have any questions for any of our panelists.
How do you guys, as investors, see the credit gap that is ever expanding and is always expanding, right? What are the contributions and what is the roadmap going ahead to reduce this credit gap from region to region or country to country?
Yeah, sure. I can go first. I think, again, I think it's difficult to give a one-size-fits-all answer, but I would break it up into sort of two pools. One is businesses, and the other is on the retail side. I think on the retail side, you're seeing many different credit models emerge that are linked to, both offline as well as online commerce and transactions. I think there are multiple multi-billion-dollar companies in the region that have been able to establish an initial footprint on the back of digital adoption and now going offline. I think on the business side, it's been a little bit slower, but I think it's now starting to pick up. You're starting to see, B2B platforms, B2B fintech platforms that are focused on SMBs, because that SMB growth and adoption is really kind of the core and the central piece of the overall economic story of the region, I feel. So I do see that as a theme where a lot more institutional capital will come behind, both equity as well as debt. So, if you're playing in that sector, whichever side of the spectrum you're on, it's a good place to be. I don't know if anyone wants to add to that, but...
Yeah, so we basically look at the credit. So we are a credit fund, right? We're $1 billion credit fund who invests specifically into let's say companies that are coming out of countries. We're based out of here in Singapore. Companies coming out of Indonesia, India, all these companies that want to actually access the global market. And on the business side, so Rishabh mentioned the retail side. On the business side, when we look at a company or a credit opportunity, I definitely believe that there are it has improved a lot, but there still needs to be a lot of improvement. So when you compare a similar business in what could be perceived, what is still perceived as low risk country, I think their credit worthiness is much higher from a risk perspective. If you are an institutional investor, you're always looking at it, right? But the impact that can be created by investment in what is perceived as a slightly more riskier geography is way different, because the kind of impact that can create in terms of social or economic impact is way different, and it's massive. So every dollar, the impact return that you get on every dollar that you invest is very, very different from the impact return that you can get by investing into something that's different, right? So in a different geography, which is considered slightly less riskier. So that's from the that's my answer to on the business side of how things have been evolving. And I think this people will start realizing, especially the institutional investors will start realizing, and many of them already are, right? And they will put in changes, and things will change.
Any other questions from the...
Hi. My question is pretty simple. So for a startup, from the idea phase to the execution to the expansion, right? Based on your take, when do we actually approach the VCs? Or which stage do we come in?
As early as possible.
As early as possible. Do you have any specific stages in mind that you guys
I think
feel?
when you're clear with your idea, and when you have something which you think can work, real problem solving, not just the idea, you should approach as soon as possible. That's the real answer.
See, it purely depends upon your stage of the company and the fund requirement, to be very honest. I will not say that you should raise lots of money these days. I believe that be bootstrap rather than taking money, then spend it and burn it. Rather, make a sustainable business if it is possible. And in case you need growth capital, then only you should approach VC fund. And if I will bifurcate that, there are two kind of fund available. One is angel fund and one is VC fund. So make sure that you well utilize the money whichever you have raised in the early stage. Make it sustainable. Go as long as you can, make the valuation high, then only dilute less. So that's what is my latest learning. Rather than diluting at a very early stage, that will not help you at all.
Okay, thank you. Thank you for the questions from the audience. So I think we have about just less than 10 minutes left. And I think we will take the opportunity, because we've been very much speaking about impact investments, about opportunities, about companies that VC firms actually find in the market and how they identify them with regards to their specific impact. I think we actually are honored to have Amit here actually present a portfolio company who is creating pretty significant impact in the markets. And it'd be great to explain the process, the investment process through which you went through to identify this specific company, and then the impact that is actually being created.
Yeah. So these guys met me at Bhubaneswar. They are part of KIT TBI, where I interacted with them. And when they met me, they showcased that how they are creating an impact in healthcare industry. In fact, they did one experiment on me as well. They asked me to, sir, please can you be at side and we will do your ECG. I was little worried that what will be the outcome of the result. But when they show me the result and this was accurate, and that ECG which they have shown was similar to what our doctors provide. So I really love the idea, and I asked them to meet me in Delhi, and we did the technical due diligence. We did our other due diligence, that how this product will be impact lots of life. The good part which I like about this product is that it is not dependent upon the internet. Means there are n number of products available which are similar to that. I will not say that products are not available, but in most of the cases your dependency is on internet, and in India it is not, internet is not available all across the country. There are still some villages and the tier 3 cities where you have a connectivity issues, and when you are going to see the patient, then also that. So once we see the impact, once we saw the cost benefit analysis as well, because the costing part is also very interesting. Means that is very 1/3 of the cost of the other products which are available in the market. Then we decided to invest in that company, and we as a VC fund invest in that company. We were the second investor. Before us, there was one investor based out in Kolkata. So that's how we decided, and we'll be happy to share what they are doing right now.
I think it's a prime example of, again, just to maybe summarize, that the investment is into a company that provides affordable access to healthcare and health services in very rural India, which is generally not attainable for the masses who live in marginalized populations. So in terms of significant human social impact, as well as on the healthcare impact of society, it is pretty profound. Would you like to invite the company on stage?
Larky, I can, Abhilash and Pitam can come on the stage. Santosh ji, I believe Santosh ji, you should also become part of it, and everyone should launch this product. So Rishabh, why don't you take a lead to unveil this product? This is a new product which Abhilash will explain that how it will impact.
No. So Amitji talked about the ECG. Now for the first time, we're introducing a smart multi-parameter monitor. This captures all the vital signs of the body. So not just an ECG, but even blood pressure, SpO2, temperature, and respiratory rate. Without the support or need of internet, this device has got artificial intelligence embedded into it. And this gives you the same accuracy and the same intelligence which 1,000 cardiologists put together can give. So this is our Health Assist. And this is integrated with ChatGPT. You can upload your vital signs and ask a query, what does this vital sign indicate? And once you do that, it'll read patterns into your vital signs, whether it's ECG or heart rate or SpO2 or temperature, and tell you how good your health is right now, and integrates all 5 vital signs into one holistic view. So that's basically a world's smallest. And as I mentioned, it's also a breakthrough innovation, because Similarly, legacy companies like Philips GE make it at about 4 times the cost of what we do. And we have also integrated artificial intelligence and connectivity into it. So you can use it in the rural setting without any network, or you can use it in a large hospital with by digitizing the entire medical record of the patient. So we have a QR code which captures the exact moment in which an incident happens, and that can be transmitted to the doctor over a app. That's basically Laka is REN.
So we are unveiling the device and the app associated with the innovation right now. Yeah.
I think we can agree this is literally an example of innovation and the use of new technology with its generative AI and putting that very much to use for the purposes of social impact. So thank you for presenting. So I think that actually brings us quite nicely and timely to the end of our panel. I'd like to thank all our distinguished speakers for their contributions and best practices in the industry. And we actually look forward to, obviously following the impact investment market. I think it's very much a significant trend that is not going away anytime soon. So I wish you all the best and look forward to the next stage of impact investing.
Hey, thank you, Meeta. I think it's an excellent and meaningful conversation you guys had. I think to appreciate, I invite Santosh here to give a memento to all the panelists. Meeta, first. Please. Yeah. You can go to the center of the dais. Okay, thank you. Diano. Okay, excellent. Rishabh, please, for Rishabh. Yeah. Now, let me invite Don from GCPIT. Hi, Nawash. Closer? Yeah. Amit? Yeah, I can. Thank you. All right, thank you. I think let's give a round of applause for the panelists.